Welcome to the deep dive. So, if you've been keeping an eye on the market, you know stocks have been, well, kind of wild lately, really defying the crowd.
Yeah, definitely.
I mean, that stretch from the April low up to the July peak, that was actually the best run we've seen in 5 whole years.
Quite the climb.
It really was. Incredible climb. But, that naturally makes you wonder, yeah, are we looking at potential summertime pullbacks? Are they a danger? Or could they actually be, maybe surprisingly, what long-term investors are looking for?
Mm.
Today, we're going to do a deep dive into this. We're looking at a really great piece by Lucas Downey over at moneyflows.com. It came out July 17th, 2025, and it's titled Summertime Stock Pullbacks. Buy the Dip.
A very provocative title.
It is. And our mission today is to tackle that exact question head on. We'll use Lucas's data, his analysis, to figure out if potential market weakness this summer is a sign to, run for the hills, or maybe a signal to jump in.
Right.
We're going to look closely at two powerful studies he uses that seem to point towards a pretty surprising answer.
Yeah, and that's a perfect way to frame it. Because I think it's critical to understand right off the bat that the overall picture, the backdrop for risk assets, it's actually overwhelmingly positive right now.
Okay.
You've got earnings working, huge investments pouring into AI stuff.
Yeah.
It's creating this really strong foundation underneath everything.
Right. The fundamentals seem solid.
Exactly. But, and this is the key thing, even with that strong outlook, healthy pullbacks are just, well, they're normal. You should almost expect them as part of the market cycle.
Okay.
And, anyone who remembers last summer, 2023, knows those low liquidity periods.
Oh, yeah. Quieter trading.
Right. Less trading volume can kind of amplify the price swings, makes the market a bit more sensitive to news, maybe leads to more volatility. So it's definitely a dynamic time.
Okay, so let's rewind a bit then. Let's cast our minds back, just 3 months to April 2025.
Feels like ages ago now.
Doesn't it?
Mm-hmm.
The market really felt like it was hitting rock bottom then. There was some really violent forced selling happening, panic. Yeah, and genuine fears, people whispering about a Great Depression because of all the tariff talk. It was intense. Really felt like panic was in the air.
It did.
And Lucas Downey, he was actually quite insightful back then. I remember seeing on April 10th, he pointed out he was seeing, I think it was 15 extreme charts.
That's right.
And he said he believed the unthinkable was ahead. What was it back then? What was signaling something potentially big was about to happen?
Well, it's really a classic setup, isn't it? Extreme sentiment. When you have that much fear, that much forced selling, and then suddenly money, like big institutional money, starts rushing back into equities.
Okay.
The major indices, they don't really have anywhere else to go but up. It's like releasing a coiled spring.
Oh.
And that recovery, it's been nothing short of remarkable. From the low point, that was April 8th, to the recent high on July 10th, the S&P 500 shot up just over 26%.
26%. Wow.
Yeah. To give you some context, that's genuinely one of the steepest rallies over that kind of time frame that we've ever recorded. It just shows you the power when a market flips from peak pessimism.
So look, if you were listening back then, if you were one of those folks who went against the crowd, maybe leaned in when things looked bleak, well, congratulations.
You did well.
You certainly caught a massive wave. But okay, after a climb like that, 26%, that's huge and rare. What does the data typically tell us happens next? Is some kind of pullback almost guaranteed after that kind of monster rally?
That really is the million-dollar question, isn't it? And this brings us right to the first key study that Lucas highlights in his piece. It's about what happens when the, quote, big money index falls out of overbought.
The big money index, or BMI.
Exactly. The BMI, it's their proprietary indicator, but basically it tracks when significant amounts of institutional money, the big money, are flooding into stocks.
So high BMI means lots of buying.
Precisely. And right now, or as of the article's writing, the market had been technically overbought according to this index for 25 straight sessions.
Okay, and is that long?
It is. It's actually beyond the typical average, which is around 21 sessions. So it's been in that zone for a while.
Right.
And historically, Lucas points out, when the BMI finally drops out of that overbought zone, well, that's when the major indices tend to struggle a bit.
Okay, so what did the numbers actually show? What kind of struggle are we talking about?
Yeah, the historical data for the S&P 500, when the BMI falls from overbought, it looks like this. After 1 week, the average return is minus 0.9%.
Okay, small dip.
After 2 weeks, it's minus 0.8%. After 1 month, minus 1.4%. And 2 months out, it averages minus 1.9%.
So negative across the board for the first couple of months.
Correct. What this data really suggests, strongly suggests, is that the market kind of needs to shed some of that excess froth after a big run-up like that.
As it needs to catch its breath.
Exactly. It's like an exhale. It needs to consolidate, shake out some weak hands maybe. And importantly, this historical pattern suggests that this cleansing action, this pause, often precedes healthier, more sustainable growth later on. It's more of a rebalancing act than a signal of a crash.
Okay.
And it's not just the S&P 500 either. He notes that previous times the BMI fell out of the red zone, you saw similar struggles historically for indices like the NASDAQ and the S&P Small Cap 600 too.
Okay, well, that certainly seems to back up the idea that summertime, it can get a bit dicey for stocks.
Yeah, seasonality can play a role.
It feels like maybe a natural time for the market to, find an excuse, right? To give back some of those absolutely monster gains we just saw, especially like you said, in those potentially lower liquidity summer months.
It lines up.
So, okay, this first study, it kind of sounds like a flashing yellow light, doesn't it? Maybe even red.
Yeah.
Warning sign to be cautious.
It could seem that way initially, yes.
But, and this is where it gets really interesting, here's the counterintuitive part that Lucas really digs into. He says, basically, don't let this potential pullback alarm you.
Right.
Instead, let it arm you. Because the core recommendation, the headline of the piece, is super clear. If you see summertime stock pullbacks, buy the dip.
Buy the dip.
And he says with both hands. So pretty aggressively. But hang on, why? Why would you lean into weakness when that first study suggests caution?
And that's where the second and arguably even more powerful study comes in. This provides the crucial context. It's titled Summertime Stock Pullbacks. Buy the dip after 26% surge in 63 sessions.
Okay, so focusing on the magnitude of the prior rally.
Exactly. Just think about how incredible that stat is again. Since 1984, so going back decades, there have only been 20 instances where the S&P 500 gained 26% or more in just a 63-session window.
20 times since 1984. That's incredibly rare.
Ultra rare. That's how unusual the move we just experienced actually was. And just to give you a feel for when these things happen, the last few times were like July 2020.
Coming out of the COVID crash, right?
Exactly. Before that, you have to go back to 2009 when stocks were just starting to heal from the global financial crisis.
Okay. Another crisis recovery.
Right. And even before that, January 1999, near the end of the dot-com boom. These are major market turning points, often associated with recovery from deep stress.
Interesting context. So these huge, fast rallies tend to happen after big dislocations.
Often, yes. And what's really fascinating, the crucial piece here, is what the data shows happens next, after these rare 26% surges.
Okay, lay it on us.
All right. So 1 month later, on average, stocks actually do fall slightly by 0.6%.
So there's that little sputter, maybe connected to the BMI signal we just talked about.
Quite possibly, yes. That short-term dip seems consistent. However, look further out. 3 months later, stocks, on average, jump 7.1%.
7% in 3 months is pretty strong.
It is. And here's the really critical point Lucas makes. 3 months after this rare signal triggers, stocks have never been lower, historically. 0 instances of losses 3 months out.
Never. That's a powerful statistic.
It's incredibly powerful. Let that sink in. And it gets better. 6 months later, the average gain surges to 16.5%.
Wow.
And 12 months later, 1 year out, equities leap an average of 22.8%.
Okay, 16.5%, nearly 23%. Those are huge numbers.
They are huge. This isn't just random noise. It's like a statistical anomaly suggesting that these incredibly powerful thrusts off the lows, as rare as they are, tend to act like a launching pad for significant future gains. Extreme strength, it seems, often leads to more strength, not necessarily an immediate reversal or crash.
So, okay, let's try and connect these dots for you, the listener. What does this actually mean if you're watching your portfolio right now?
Yeah.
It sounds like.
Okay,
the first study, the BMI one, suggests we might see a bit of short-term choppiness, right? Pullback is definitely possible, maybe even likely, if that index rolls over.
That's fair, yes. Consolidation.
The second study, focusing on this ultra-rare 26% rocket move we just had in, 3 months, that history says any dip associated with that is probably temporary.
Exactly.
And that the odds, based on decades of data, overwhelmingly favor significantly higher prices 3, 6, and 12 months down the road. Is that summing it up?
That's summing it up perfectly. It's about understanding the character of the potential pullback.
Okay.
When a market has surged with such rare explosive force, any short-term give back, whether it's due to those overbought readings from the BMI or just general summer seasonality weakness, it's far more likely to be just a pause, a consolidation.
Right, not the start of something worse.
Precisely, not the beginning of a deep bear market. That underlying power, that momentum from the 26% surge acts as a really strong bullish undercurrent that historically tends to override that short-term noise.
So the data helps you filter the noise.
It does. It encourages you, encourages the listener to be ready with cold, hard data, and importantly, not get swept up in fear if or when the market inevitably takes a breather.
When?
It's about telling the difference between, say, a healthy market exhale after a sprint and a genuine structural problem. And this data points very strongly towards the former.
Right. It frames any potential dip not as a disaster, but as perhaps that very opportunity Lucas Downey is talking about.
That's the core message.
Okay, so the key takeaway then, the really powerful, actionable insight from this deep dive seems crystal clear.
Yeah.
By any summertime dip, ride the rip.
That's the mantra from the data.
All right, so let's leave you with this thought then. Given this really compelling historical data, suggesting significant long-term gains are likely after such a rapid and, importantly, rare surge, what does that mean for your own personal approach? How you think about managing these short-term market ups and downs? I mean, how can you cultivate that mindset, that conviction to actually buy the dip when maybe your gut or the headlines or everyone around you might be feeling fearful?
It's a great question. Maybe consider how understanding these kinds of historical patterns, this data, can actually empower you to act decisively, perhaps when others are hesitating.
Yeah.
Turning what feels like a setback, what everyone else might perceive as a negative, into what could genuinely be a significant long-term opportunity for you, using data to overcome emotion.